To conclude today's symposium, I'd like to give you an overview of how Pablo and I work together to manage Graham and to achieve our goals and objectives. We're also going to answer any questions you may have, so feel free to submit them whenever you have the moment to do so. Pablo and I are going to spend time on some of the issues that we focus on, and I'm also going to ask Pablo some questions as appropriate, and then I'll elaborate on some of his answers. Let me start with Pablo. How does Graham benefit from having both quant strategies and discretionary strategies under one roof?
Yes, thanks, Ken. And yeah, clearly we benefit a lot. I can think of many examples. Let me start with the cross-pollination that there is between quants and discretionary PMs. Oftentimes, quants are working on a signal that might require a deeper knowledge of market structure, and because PMs are very close to markets, then they can help with that. And then vice versa, you have PMs that might be working on something that requires more of an analytical, quantitative help, and then they can find that in the quant team. So that would be one. I would say at the managerial level, at our level, we benefit a lot from supervising two different strategies and see how they behave in different market regimes. That's very informative, not only in terms of what's going on in markets, but in terms of then future signal development. And I think that was a critical ingredient when we developed GQM. I think GQM uniquely benefited from having that discretionary flavor that we were able to infuse into that program. And then lastly, there's the client side. We have these two sources of alpha, quant and discretionary. Some clients are one with one or the other, but then some clients really want to have a combination of both, and we can then work on bespoke solutions that combine the best that we have at Graham.
Yeah, Pablo, I agree with everything you've said, and particularly in the last case, it reminds me of how I invest our proprietary capital. I don't commit to either discretionary or quant in isolation. I commit to both of them, and I find that they balance each other quite nicely. I also think about how you and I work together. When I think of you, I think you have a brilliant mathematical, scientific, analytical mind. I come at the world from a practical perspective of having been around the markets for so many years, so many decades. And I think we really balance each other out a lot. And I think that we also enjoy that in our discretionary and quant business. What are some of the key business opportunities that you see for Graham, both in the short run and over time?
Yeah, well, and thank you for your words, and I feel very much the same. And well, look, we have had a series of discussions earlier today, and I think that we are in a golden time for discretionary trading and for all things related to macro. Some of our PMs call this a generational moment for macro, which I think really has to do with inflation and the nature of inflation, right? For the last 10 years or so, all central banks, the Fed in particular, have been able to suppress volatility, to meet every shock that financial markets had by looser and looser monetary policy. And that created a very artificial environment where not too many things were happening. But now that genie is out of the box, right? Now we have inflation, and inflation has to be met by tighter monetary policy. So we have a situation where a shock has to be met by another shock, and that creates huge volatility. The other thing to top that up is that, and we've done some good research on this, when inflation is high, and in particular when core inflation is high, asset classes tend to perform really, really poorly. So the need for macro in portfolios, we feel it's always there, but we feel going into the next years, maybe even the next decade, the role for macro in portfolios will be critical. And I think that presents a great opportunity for us to help investors with portfolio solutions.
Yeah, I think about this subject of inflation and how sticky it may be. And I think about, the factors that influence that. And, as an example, the workforce and how everybody that we meet in the workforce today has never really been through a recession if they're under 33 or 34 years old. And so they're not really experienced in an environment where the employer is going to be more and more demanding of them because they have to in order to make their business successful. And so it's going to be slow for their expectations about compensation to evolve. And I think it will change, but I think some of the wage pressures that we see that are so inflationary, they're not going away anytime soon. I think the psychology of the workforce is going to be slow to evolve. It will, but it's going to take time. Um, what are some of the key lessons, both prior to Graham and at Graham? It's been 11 years that are you think would be worth discussing with some of our clients?
Well, many, but to name a few, I think that markets are extremely dynamic and you have to expect the unexpected. I think your next shock is really not your last shock. So you have to be very open-minded. I think we have many tools to think about risk. But for example, if you think of value at risk as one key measure, and I think it's a very useful measure, but it's really only useful for a very short-term horizon. I think when you think about longer horizons, risk really doesn't scale up with a square root of time, but it can actually go up a lot more. So you can have to think about scenarios that are out of the box, do a lot of scenario analysis that we do. Markets also can change a lot and can change in ways that you don't expect them. For example, liquidity is a key issue. Many markets have this so-called wrong way liquidity, where you have the liquidity when you don't need it, i.e. when things are very stable, and then when markets become stable and you need liquidity, liquidity can disappear. So I think from a risk standpoint, there are many lessons, but more than anything is to be able to be very open, to think that the world is not this perfectly Gaussian, normally distributed world, but that very unlikely and extreme scenarios are very happen. And you have to be prepared to deal with those.
Here, here. I mean, I think the lessons that occur to me over time is when liquidity changes, you want to be out in front of that, not
Yes.
behind it. And if you can get out in front of it, realize that there's a new regime about to happen, and you'd better ask questions later and get out first. That's something that I just think is so important. Let's talk about quantitative equity market neutral and why our efforts in this area are so appealing and important to Graham and our clients.
Absolutely, yes. So to begin with, right, you said equity market neutral, right? And there are many programs out there that are called equity market neutral, and they truly are for these very small changes, right? So market moves 1-2%, they feel very uncorrelated to the markets. But then you have big market sell-offs, and then they have the correlation. So they are not truly market neutral. So one of the things that we really wanted to do was to create a strategy that was truly market neutral, that was hedged to many of the most common style risk factors, right? And whereas you cannot have something that has no volatility, we really try to have something that has very low correlation to equities. And I think we've done a very good job at that. The second part that I think was important was we wanted to have a strategy that has low leverage. Leverage can really be one of the big sources of left tail. So building a strategy that was hedged, but also was not hedged at the expense of very high leverage was very, very important. And I would say the last and maybe the most important part is that we wanted to deliver true alpha to clients. We wanted to have many idiosyncratic and newer sources of alpha. And I think we have accomplished that. I think we have accomplished to build a portfolio that has very interesting alpha with very, very low market correlation. And that makes it very unique.
Yeah, no, I agree with everything you said. I mean, to expand for a moment, if our equity quantitative business is not really correlated to the market, if it's not correlated at all to our macro alpha strategies, it's super appealing to me as an investor. And as you know, I put a lot of proprietary capital in our equity quantitative strategy because of those two factors. I like the fact that it's not correlated to other strategies at Graham. It's not correlated to the market. Let's talk about culture for a minute. What makes Graham unique? Uh, what allows us to develop and retain key talent? And if you could spend a minute on that, if you don't mind, Pablo.
Sure, and I think like with everything, it's a combination of factors. You created this great company almost 30 years ago, and for 30 years we have been doing macro and other things, like you said, quantitative equities. But just think about this: the institutional knowledge about macro, all things macro, discretionary, quantitative, that we have in this house is actually very quite unique. So I would say that that's one. Second, I would say when you look at people around here, we have people that have been here many years, decades sometimes. Now, you might think that that's a bad thing, but these people started here mostly really young, right? And they have not been in the same place forever. They have actually grown with the organization. They have evolved with the organization. So they have a lot of institutional knowledge. And then lastly, we have been also able to attract super talented people that mix with these longer tenure people in a really good way. So I would say it's the combination of all those things: being innovative, being creative, working with our employees in a way where they feel they really need to work hard to develop alpha, but also we are a great embracing culture as well. And I think all those things make us very unique.
Yeah, Pablo, I agree with what you've said. I think, if I were starting my career, uh, what would be important to me? I'd want to be around very bright people who are innovative, who are creative. I'd want to be around people I could learn from. That's the most important
Yeah.
thing. And as I think about the culture that we enjoy at Graham, it's not all about business. We take people's well-being more seriously here than I think some others in finance perhaps do. And I think that's why we've been able to retain, develop, cultivate the kind of talent we enjoy at Graham, is that we are a people-first organization. It may cost us some money to run the firm that way, but I think it's dollars really well spent for Graham and for our clients and clearly for our employees. Obviously, this has been a strong start to the year for macro for Graham. Do you feel it's performance chasing to get involved at this time if you weren't already involved at the start of the year?
I don't, and let me back up that claim. So if you look at, to begin with the discretionary side, for example, so we had, and if you look at prior to 2010, right? So the 10-year period between 2000 and 2010, we had really very strong returns in those 10 years, average returns, right? Close to about 15% per year average return. And then you look at the 10 years after that, so the period of great moderation, very heavy central bank intervention, volatility suppression, so on and so forth. And then the returns were positive on average, but they were lower. They were more in the order of 5 to 7%. So when you look at returns on the discretionary side, they seem to be going through these long cycles that really coincide with the macro cycles, right? With what central banks are doing, what inflation is doing. Are central banks able to suppress volatility or not? And one thing that we have discussed at this panel is that volatility is here to stay. And we think that the next 5-10 years are going to be much more like the pre-2010 than the post-2010. And that tells me that returns on the discretionary side are going to be very robust. On the quant side, a little bit of a different story, but more or less the same conclusion. And there was a little bit of a discussion about this in the earlier quant panel. So we have done many studies about predictability, like we do on our quant side, use quantitative methods to forecast and predict. And we have found no correlation between past performance and future performance. That doesn't mean that we're going to do better or worse. That means that if we have done really strongly, that does not predict strong or in particular to your question, a mean reverting case, right? So I think both businesses are really independent of their past performance. And if you think about discretionary, I would venture to say that strong performance is somehow predictive of future strong performance because we're going to be in this cycle for a while. So I don't certainly think that this is peak performance, that there will be mean reversion, that you would be performance chasing. And in fact, I would think that if you were to delay the investment now, you would be really staying away from one of the best, most profitable opportunities that we have seen in macro in many, many years.
Yeah, I think about this subject a lot. First of all, general advice I have on investing in what we do is I think it's important to just sort of be even paced about how I invest proprietary capital. I try and be really consistent. I try and have consistent exposure over long periods of time and take luck out of the equation and be invested for the good cycles for what we do, even if it's not been so interesting the last couple of years. I just try and stay committed. I think about the environment going ahead and how it compares to the last 12 years. The last 12 years, as we've talked about today, great environment for beta, particularly as relates to risk-free rates. Risk-free rates were essentially zero over the last 10, 11 years. And so if you were generating 10+% in beta, not only was that a great return, but it was a great relative return to risk-free rates. Now risk-free rates have moved up quite a bit, 300-400 basis points in the last 6 months. And if equity returns are not say half of what they were in the previous decade, the relative outperformance of equities to risk-free rates is much less appealing than it was in the last decade. The factors that make macro interesting and constructive, foreign exchange volatility, interest rate volatility, equity volatility, commodity volatility, supply chain bottlenecks, these long-term trends on inflation, I don't see them going back to the previous decade anytime soon. So I'm particularly excited and enthusiastic about what we do for the foreseeable future. I realize this has been a better period than some we've seen in the past, but I've seen years when I go back to 2001, 2002, really exciting back-to-back years, 3 years in a row for our trading. And I kind of feel like we're in that environment again. I want to be cautious and not count on that. But I also don't want to, think that this environment and the factors that are causing it are so constructive. I just don't see how that changes overnight. So I am very cautiously optimistic on the outlook for Graham and our clients going forward. I want to thank everybody in the audience for your time today. We greatly appreciate your confidence in Graham. We look forward to an exciting market environment. We're going to stay diligent at Graham and managing risk. We're going to stay very motivated on finding new sources of alpha. And we want to also always be that conservative institution that we've been for the last 28 years, which is managing your capital along with our proprietary capital as conservatively as we can while still doing our job, which is trying to find the most excellent returns possible for you with the most prudent risk management possible. So once again, we appreciate your confidence in Graham, and we thank you for joining us today.